There is a single island, smaller than the state of Maryland, that the entire modern economy silently depends on: Taiwan. It manufactures the overwhelming majority of the world's most advanced computer chips, and 100 miles across a narrow strait sits a government that has said, in writing, that it intends to take it. The market treats this as a tail risk. I'm going to show you why it is not priced at all, and who gets paid if it happens. I am going to walk you through 3 publicly traded companies that would not just survive a Taiwan crisis, they would be the contingency plan, and they would be repriced in a single trading session. Not the household chip names everyone already owns and everyone already argues about, not a defense fund that holds 40 contractors and a strong view on none of them. Real businesses with factories and tooling bolted physically to the ground in places that are not Taiwan, that every government and every hyperscaler on Earth is now quietly paying to exist as insurance. The world has spent 3 years and hundreds of billions of dollars building a backup for the most concentrated supply chain in human history. The trade I want to show you is simple. Do not try to predict the date of a geopolitical event nobody can predict. Own the insurance policy that pays out the moment the market even starts to believe it. Let's get into it. First, a level set, because you cannot trade a thesis you do not understand. The story you have heard is tension over Taiwan. The story underneath is a concentration so extreme, it should not legally be allowed to exist in any other industry. One company on that one island fabricates the large majority of the world's most advanced logic chips. The chips inside your phone, inside the cloud, inside every AI accelerator that matters. Let me put the concentration in plain terms. If the most advanced chip output of that island stopped tomorrow, there is no second island. There is no spare fab sitting idle that can absorb the demand. The replacement capacity at the leading edge is measured in years to build, not months. The entire technology economy is balanced on a single point of failure inside artillery range of a rival power. Now stack that against the politics. The government across the strait has stated, repeatedly and officially, that unification is a national objective and that it does not rule out force. It runs military exercises that rehearse openly the encirclement of the island. And here is the part the market keeps waving away. You do not need an actual invasion to break this supply chain. You need a blockade. Ships and aircraft simply ringing the island and stopping commercial traffic. No shots fired. No territory taken. Just a quarantine. And a quarantine would still strangle the flow of the most important manufactured good on the planet. Here is the part that should be tattooed on every trader's monitor. The world's governments already know this. They have known it since the supply shocks of the early decade, when a chip shortage alone idled auto plants and erased real economic output. So for the last 3 years, there has been a deliberate, enormous, state-backed campaign to build advanced chip manufacturing capacity anywhere that is not Taiwan. The United States passed legislation putting tens of billions of dollars of public money on the table for domestic fabs. Europe did its own version. Japan did its own version. Every advanced economy reached the same conclusion at the same time. This concentration is a national security emergency, and it has to be diversified at almost any cost. That campaign is already funded. The factories are already being poured in Arizona, in Ohio, in Japan, in Germany. So the trade is not a bet on whether the crisis comes. The trade is recognizing that the world is already spending the money, the build-out is already underway, and the companies executing it get paid either way. They get paid steadily if it is just insurance, and they get repriced violently if the insurance is ever needed. So you have an irreplaceable supply concentrated on one exposed island, and a global, government-funded scramble to build an alternative before the music stops. When that happens, 3 things get extremely valuable extremely fast. First, anyone building leading-edge chip capacity on safe soil. Second, anyone who makes the irreplaceable machines that every fab on Earth must buy to operate. Third, anyone who tests and packages the finished chips outside the danger zone. So I am going to give you one company per layer. 3 names. 3 different ways to express the same macro bet. Name 1. Taiwan Semiconductor Manufacturing Company. The ADR trades in the United States. Ticker TSM. You might think it is strange to name the Taiwanese champion as the safe soil play. It is not, and that distinction is the whole trade. This company is the foundry at the center of the entire concentration story. It is the firm whose island location is the risk. But that is exactly why what it is doing now matters so much. Under direct pressure from its customers and from the United States government, this company is building advanced fabs outside Taiwan, a multi-fab complex in Arizona, capacity in Japan, capacity in Germany. And critically, these are not token plants. The Arizona investment alone runs into the tens of billions of dollars, with multiple fabs and advanced process nodes planned. So here is the logic. The company that is the single point of failure is also the company most aggressively building its own redundancy on safe ground. If the crisis never comes, it keeps compounding as the most important manufacturer on Earth. If the crisis does come, the off-island capacity it is pouring right now becomes the most valuable industrial real estate in the world overnight. Here is what changed. For most of its history, this company's strategy was relentless efficiency through concentration. Keep the most advanced manufacturing clustered tightly at home in Taiwan, where the engineering talent, the supply chain, and the infrastructure all sat in one optimized cluster. Geographic concentration was a feature. It made the company the lowest cost, fastest iterating foundry on Earth. Then geopolitics turned that feature into a liability the company could no longer ignore. Its largest customers, the American technology giants, began telling it directly that they needed supply that did not all originate inside artillery range of a rival military. Some of those customers were willing to pay a premium for chips made on American soil specifically. Governments were willing to hand over public subsidies to make the economics work. So the company did the thing it had resisted for decades. It began to deliberately deconcentrate. And read that correctly. When the lowest cost producer on the planet voluntarily accepts a higher cost manufacturing footprint, that is not a mistake. That is the company pricing in a risk the stock market still refuses to price. Management sees the strait. They are building the lifeboats while the sea is still calm. So what does this actually mean for the stock? 2 things, and they pull in the same direction. First, the base business. This company manufactures the chips at the absolute leading edge, the chips that the entire artificial intelligence build-out physically depends on. As long as AI compute demand keeps climbing, its order book stays full and its pricing power stays exceptional. That is the engine that runs whether or not anything happens in the strait. Second, the option. Every fab it completes outside Taiwan is, in effect, a free call option on a geopolitical shock. Think about the asymmetry. In calm conditions, that off-island capacity is just steady, profitable manufacturing, a modest drag on margins from the higher cost base, nothing dramatic. But in a crisis, a blockade, an invasion scare, even a serious escalation that never goes kinetic, the value of advanced chip capacity that is physically safe would spike to a level that is hard to even model. You would be holding the only company that is simultaneously the most important chip manufacturer on Earth and the owner of the world's primary chip supply backup. One ticker, both sides of the trade. Now the bear case, 3 things to watch. 1. The island risk is real, and it cuts both ways. A genuine kinetic event would in the short term be chaos for this stock before any safe soil premium asserted itself, because the majority of capacity still sits in Taiwan today. 2. Building fabs outside Taiwan is expensive and slow, and the company has openly acknowledged that overseas costs and timelines are tougher than at home, which pressures margins. 3. The stock is tied to the AI cycle, so a genuine slowdown in AI spending would hit the base business hard, regardless of geopolitics. So how do you trade it? I am not going to give you a price target. Price targets are how analysts get quoted, not how traders make money. I will give you the framework. This is the cleanest single name that gives you both the AI manufacturing engine and the geopolitical hedge in one position. Watch two things on every quarterly call. First, the progress and the production status of the overseas fabs, Arizona above all. How many are running, at what node, at what volume? Second, leading edge capacity utilization and pricing, because that is the health of the base business. As long as the overseas build-out keeps advancing and the leading edge order book stays full, you own both the compounder and the insurance policy. If the overseas fabs stall, if timelines slip badly and the deconcentration stops, then the hedge half of the thesis is the part that weakens. The base business would still be there. The lifeboat would not be getting any bigger. Name 2. ASML Holding. The ADR trades in the United States. Ticker ASML. This is, in my view, the single most irreplaceable company in the entire technology economy. And almost nobody outside the industry can even name it. And the reason it is misunderstood is that it sits one full layer upstream of everything the public watches. This company does not make chips. It makes the machines that make the chips. Specifically, it is the only company on the planet that builds extreme ultraviolet lithography systems, the machines that print the very finest circuit patterns onto silicon. Not the best at it, the only one. There is no competitor, there is no second source. Think about what that means for a moment. Every single advanced chip in the world, in Taiwan, in Arizona, in Japan, in South Korea, is printed by a machine from this one company. If you are a government trying to build chip capacity on safe soil, you cannot do it without these machines. If you are a foundry deconcentrating away from the strait, every new fab you pour needs a fresh order of these machines. The entire global diversification campaign, the whole multi-hundred billion-dollar scramble, physically routes through this company's order book. Why does that monopoly hold? Because the machine itself is arguably the most complex device humanity has ever mass-produced. An extreme ultraviolet lithography system is the size of a bus, costs well over $100 million, and contains hundreds of thousands of precision parts drawn from a global supply chain that took decades to assemble. It works by vaporizing droplets of molten tin with a laser tens of thousands of times per second to generate a specific wavelength of light, then steering that light with mirrors so flat that scaled up to the size of a country, the largest bump would be a fraction of a millimeter. You do not reverse engineer that. You do not stand up a competitor in 5 years with a pile of cash. The knowledge is distributed across this one company and its tight web of specialized suppliers accumulated over 30 years. So here is the hard logic. The world wants to build chip capacity everywhere at once. Every one of those fabs needs these machines. And there is exactly one company that can make them, with a production rate that is physically limited. When demand is global and unlimited, and supply runs through a single constrained factory, that company does not take prices. It sets them. The number that matters here is the backlog. The backlog is simply the value of all the orders a company has signed but not yet delivered. It is the visible future, written down in contracts. This company carries a system backlog measured in the tens of billions of euros, representing years of production already spoken for. That is years of revenue locked in before it builds one additional machine. For a company that ships a relatively small number of extraordinarily expensive systems each year, A backlog like that is close to certainty. And the geopolitical scramble is precisely what keeps that backlog fed. Every new fab announced in the United States, every new fab in Japan, every new fab in Europe is, downstream, an order for these machines. The diversification campaign that the whole world has committed to cannot physically execute without buying this company's output. There is also a quieter, recurring layer to the business that the market often underweights. Once a machine is installed, it generates years of service, upgrade, and spare parts revenue. The installed base itself is an annuity. So you own a monopoly on the equipment, plus a growing annuity bolted to every unit ever shipped. And here is the kicker. This company sits directly inside the great power technology fight. And that cuts in a way the market does not fully respect. The United States has pushed for, and largely secured, restrictions on selling the most advanced of these machines into China. On the surface, losing access to a large market sounds like a clear negative, and the stock does react to every headline on the subject. But look closer at the structure. The export limits funnel the company's constrained production toward the United States, Taiwan, Japan, and Europe, exactly the jurisdictions running the safe soil build-out. The machines that might have gone to China get redirected to fabs that are part of the diversification thesis instead. Now, the honest catch. China has been a meaningful slice of revenue, and headline restrictions create real, sometimes violent, short-term volatility in the stock. But read the long arc correctly. The structural demand from the deconcentration campaign is what is durable, and the company sells the one tool that campaign cannot proceed without. The bear case. 1. This is a long cycle equipment company, so its order intake is lumpy. A quiet quarter or two of bookings can spook the stock even when the multi-year story is intact. 2. Export restrictions to China remain a live political variable, and each new rule resets the headline risk. 3. The stock trades at a rich valuation that already reflects its monopoly, so any disappointment in the fab build-out pace gets punished hard. How I think about the trade. This is a long-duration compounder, not a one-quarter catalyst. If you believe the world will spend the next decade building chip capacity outside Taiwan, and every government on Earth has now committed to exactly that, this company sells the irreplaceable machine that build-out physically cannot run without. Watch two numbers on every earnings call. The system backlog quarter over quarter, and the order intake, the value of new machine orders booked. As long as the backlog holds and new orders keep flowing, the diversification campaign is converting into this company's revenue exactly as the thesis requires. If order intake stalls for several quarters in a row, that is the signal that the fab build-out is slowing, and that is your cue to reassess. Name 3. Amkor Technology, ticker AMKR. We have covered the company building advanced capacity on safe soil and the company that makes the irreplaceable machines. But now step back and follow a chip through its actual life. A finished wafer rolls off a fab line and people assume the job is done. It is not. That wafer still has to be sliced into individual chips. Those chips have to be packaged, encased, wired, and connected so they can be mounted onto a circuit board. And then every one of them has to be tested to confirm it works. That back-end stage, assembly, packaging, and test, is a real, distinct, and increasingly sophisticated industry of its own. And here is the part that matters for this trade. A great deal of the world's chip packaging and testing has historically been concentrated in Taiwan as well, sitting right alongside the fabs. So even if you build a brand new fab in Arizona, you have only solved half the geography problem. If the finished wafers still have to fly back across the Pacific to be packaged and tested near the strait, the supply chain still runs through the danger zone. A complete contingency plan needs the back end on safe soil too.
This is the layer the market consistently underthinks.
This company is one of the largest providers of outsourced semiconductor assembly and test services in the world, a back-end specialist that fabs hire to finish their chips. And it has made a deliberate, strategic move that puts it directly inside this thesis. It is building a major advanced packaging and test facility in Arizona, positioned to serve the new American fabs rising in the same state. Here is why this is such a well-positioned business in this environment. The whole point of the Safe Soil campaign is to build a chip supply chain that does not depend on the strait. But a fab on its own is an incomplete link. A wafer is not a usable product. It becomes a usable product only after it is packaged and tested. So if the United States pours tens of billions of dollars into front-end fabs and then has no back-end capacity nearby, it has built a chain with a missing link, and the chain is only as strong as that link. Governments and chip makers understand this. The same policy push and the same subsidy programs that funded the fabs are now actively encouraging domestic packaging and test capacity. This company saw that gap and moved into it early. By building advanced back-end capacity in Arizona, right next to the new fabs, it is positioning to be the company that completes the domestic supply chain. And there is a second tailwind underneath. Advanced packaging is becoming more valuable in its own right. As raw chip miniaturization gets harder and more expensive, the industry increasingly squeezes more performance out of clever packaging, stacking and stitching multiple chips together. That makes the back end a higher value, more technical business than it was a decade ago. The work this company does is worth more per chip than it used to be. And the company has been clear about the strategic logic. Management has spoken directly about positioning its new Arizona facility to serve the wave of domestic front-end manufacturing, and about long-term cooperation with the major foundry building in the same region. Read what that means for the cash flows. Back-end capacity, sited next to the new fabs, locked into serving them. That is, multi-year, recurring work bolted to the most heavily subsidized chip build-out in American history. And because advanced packaging is technical and capital intensive, it is not a business a customer casually resources. Once a fab's production is qualified at a packaging partner, that relationship tends to be sticky. That is how a back-end company compounds, not with a single dramatic catalyst, but by embedding itself into the new supply chain as the link that finishes the chip, and then holding that position for the life of the fabs it serves. It is unglamorous, it is incremental, and it compounds. The bear case. 1. This is a back-end company, and the back-end has historically been more cyclical and lower margin than the glamorous front-end fabs. It gets squeezed in a chip downturn. 2. Building advanced capacity in the United States is more expensive than in its established Asian locations, which pressures returns until the volume ramps. 3. The company is smaller and more concentrated than the foundry and the machine maker, so a single large customer's order swings matter more to it. How to trade it. This is the higher torque, smaller cap way to express the safe soil chip thesis. More volatile than the foundry or the machine maker, but levered directly to the domestic build-out. You watch two things: the progress and the utilization of the Arizona facility. Is it being built? Is it filling with work? And the share of revenue coming from advanced packaging versus older commodity packaging. As long as the domestic facility advances and the advanced packaging mix keeps rising, the company is executing the thesis. If the Arizona ramp stalls, the safe soil part of the story is what weakens. Now, and this is important, I would not bet the whole thesis on any single one of these names. I would think of them as a basket. Why a basket? Because the three sit at genuinely different points in the supply chain and carry genuinely different risks. The foundry is the most directly exposed to the island itself. It carries both the biggest geopolitical danger and the biggest safe soil option. The machine maker is the most insulated single layer, a global monopoly upstream of everyone, but it is exposed to export politics and lumpy orders. The back-end company is the smallest and most cyclical, with the highest torque to the domestic build-out, but also the most sensitivity to a chip downturn. Notice that those are three different failure modes. A chip cycle slump that squeezes the back-end company does not erase the machine maker's monopoly. An export rule headline that jolts the machine maker does not change the value of the foundry's Arizona fabs. When the risks are spread across different layers like that, holding all three smooths the ride without watering down the core idea. When you hold all three, the exposures roughly diversify each other while keeping the central macro bet intact. The world's most critical supply chain is concentrated on one exposed island, and the companies that build advanced capacity on safe soil, supply the machines that build out needs, and finish the chips off-island get paid for closing that gap.
One caveat.
If you are going to trade the chip concentration theme, you have to be honest about the shape of the risk. This is not a clean, gradual thesis. A real kinetic event in the strait would, in its first hours, be chaos for every chip stock on Earth, including these. The safe soil premium is the long-run logic, but markets do not reprice calmly during a shock. And the opposite risk matters too. If tensions genuinely cool, if the strait quiets for years, the urgency premium baked into the diversification trade fades. I do not think the concentration gets resolved soon. The build-out takes a decade and the geopolitics are not improving, but the risk premium on these names will swing hard on every headline out of the strait. Position size accordingly. Do not max out on any single name. And keep dry powder for when a straight headline spikes and the whole chip complex sells off together, because that is when you accumulate the insurance at a discount. A few catalysts I am watching going forward. 1. Production milestones at the new American fabs. First wafers, node ramps, volume targets being hit or missed. 2. Any change to the export rules on advanced lithography machines in either direction. 3. The order intake at the machine maker, quarter over quarter. 4. The construction and ramp progress of domestic advanced packaging capacity. If any single one of these key metrics cracks decisively, I will revisit the thesis on this channel. 2 more names to keep on a watch list, but I am not buying today. Intel, the American chip maker attempting a costly turnaround into contract manufacturing, high stakes, politically backed, but unproven in execution. And Applied Materials, a broad supplier of other essential chip-making equipment, a wider, more diversified play on the same build-out. I will cover both in future episodes when I have more conviction. Let me leave you with the macro frame. For decades, the world optimized its most important supply chain for one thing: efficiency. Cluster the most advanced chip manufacturing on one island where the talent and the supply base and the infrastructure all sat in one tight, brilliant, low-cost knot. And it worked. It produced the cheapest, fastest, most advanced chips in history. But it also built the single most dangerous concentration in the modern economy, the beating heart of the technology age, sitting 100 miles from a rival military that has openly stated its intentions. The world has finally seen the risk. And the response? Tens of billions of dollars of public money, fabs rising in Arizona and Japan and Germany, an entire industry being deliberately, expensively deconcentrated. That response is already underway, already funded, and largely unpriced by a market that still treats the strait as a distant abstraction. That mismatch, a clear, building, structural shift against a market that refuses to take it seriously, that mismatch is the trade. The companies building the backup, supplying its irreplaceable machines, and finishing its chips on safe soil are not a speculation on a war. They are the insurance policy the whole world is already paying for. And the time to own insurance is always before the headline, never after. 3 companies. 3 layers of exposure. 1 macro bet. The foundry builds the capacity on safe soil. The machine maker supplies the irreplaceable tool. Amcor finishes the chip off-island. If the thesis is right, all 3 compound. If the thesis cracks, you will see it in a handful of specific metrics, and I will tell you here. That is the trade. That is the headline behind the headline. If this kind of breakdown is useful to you, the kind where we do not just react to the headline, we trade behind it, hit subscribe. I will see you on the next one.